Okay, so as I promised last time, we are going to start looking at revision questions. And we said we should look at risk management when it's still fresh, and then cover the questions that are in there, just that we get an understanding of how it is. So we want to start today with this question called Nedwen or Nedwen. So it's a section C question. That means that you are working with 20 marks. So you need to, first of all, understand what are the requirements. And here you are seeing that the requirements are, first of all, to discuss the differences between transaction risk, transaction risk, and economic risk. So these are already the risks that we talked about. And you can see here you have 6 marks for just talking about those 3 things. So 2 marks per risk. So ideally, I wouldn't expect you to find any issues getting that, but we shall go through that again. Then calculate the expected sterling receipt in 1 month and 3 months using the forward market. Very easy. So we shall also handle that. Then expected sterling receipts in 3 months using a money market hedge. So we are going to start today looking at money market hedge as one of our revision questions. So of course, I didn't recommend whether a forward market hedge or a money market hedge should be used. And then also discuss how the currency of sterling futures contracts could be used. So remember, we said for risk management, we are only going to be calculating forward contracts and money market hedge. And we said that the rest of the other options, like options and futures, you have to be able to discuss them in a question. This is the first question that is actually testing you on that. So if you go to the scenario now, I'm saying that Nedwen is a UK-based company and it has the following transactions. So in 1 month, it will receive $240,000, but also in 1 month, it will pay $140,000. Then in 3 months, it will receive $300,000. So they have given you the spot rate, dollars per pounds. Then they've also given you 1 month forward rate, 3 months forward rate. And then they have given you some information for money market hedge, where you have the borrowing rate and deposit rate in pound sterling and in dollars. And they're saying that today is 1st April. So now we have to, first of all, discuss the difference between transaction risk, and economic risk. So we can start with that. So transaction risk, we have economic risk, or we start with transaction risk. Then we have economic risk. So these ones, for those of you who have been following, you know that transaction risk is the risk that a transaction will be settled at a later date, a different FX rate than it is recorded. So, and because I'm using now, I'm using language that will easily come up when you're writing. Some of you are better at memorizing than others. So you could write it as it was given to you in the notes, or you can give the context. Because the risk is that the transaction that you enter into today will be settled at a different date, at a different FX rate because of changes. So you say because of change in the FX rate. That is transaction risk. And transaction risk is the risk that a forex balance will be restated at a different amount as a result of using a different rate. Then you can say that this is not really a risk for the finance manager. And then finally, economic risk, you say this is the risk that the present value of a future investment will change as a result of changes in FX rates. You can also add that it is basically a long-term transaction risk. So you can see that these are easy marks for us to get. In actual sense, you should not be expected to really fail at getting these marks. Those are 6 marks, very easy marks to get. So we can now continue with the expected sterling receipt in 1 month and in 3 months using the forward market. So we have been given the forward rates. So we can take this information, all of it. So we have the spot rate, we have the forward rate for 1 month and for 3 months. So now remember that we are going to receive and pay. Okay, so we are going to receive 240,000 and we are going to also pay 140,000. Now, the first thing that we have to do in this case is to do what we call netting. So the net, now, because we are going to receive more than what we are going to pay out, so we have a net receipt, which is basically 240,000 minus 140,000. So we have a net receipt of $100,000. Is that part clear? Because you need to understand that since they are all occurring in 1 month, ideally when you receive the dollars of 240, you use 140 to pay off the payment and you remain with 100,000. That's what we are going to convert now to pound. So now we can say receipt in 1 month and then receipt in, so receipt in 1 month is going to be how much? So now what you need to realize is that the base currency is the pound. Now these rates, the way they have been given to you, they have given you in the form of plus or minus. So which means that the rate can be 1 point. So remember, we are looking at 1 month forward. So 1.7829 minus 0.0003. That's the first one. The second one is going to be 1.7829 plus 0.0003. So this is, now remember that this is how I gave them to you in one of the notes that we were doing, but I also mentioned that they can also be given to you like this. When they give them to you like this, it means that the first one you subtract, then the second one you add. So basically you create the buy and sell rate. Now you need to understand, of course now I'm going to just put these ones in writing for you to understand, but in the exam, you just now need to know which rate you are going to use. So we are receiving $100,000 and therefore we are converting them to pounds. Therefore we are going to buy pounds. And because we are buying pounds, the bank will sell them to us at 1.7832. So that's what the rate I'm going to use. So therefore the receipt is going to be 100,000 divided by 1.7832. And we are saying divide by because we are converting to the base currency. So that is the receipt in 1 month. Now they also asked us to find the receipt in 3 months. So receipt in 3 months. Now, what I've done here to show you that we are using the sale rate, now I don't have to go back to this again. I'm just going to come here and I say, remember that in 3 months, we are going to receive 300,000. So that is 300,000 divided by the sale rate. And now the sale rate we have identified is going to be 1.7832. 0.7846 plus 0.0004. Okay, if you understood that, you don't have to go through these other steps. You can just do it in one line. So that's how you get the expected receipt in 3 months' time. So remember, these are pounds. Do we have any issues with that? Or we are okay? Hello, do you have people who have issues with that? Is there anyone following?
Can you repeat a little bit? My internet had jammed about. I don't know if you can hear me.
I can hear you. What do you want me to repeat?
Just the calculation. My internet had gone off.
I'm saying that we are expected to receive, in the question, we are expected to receive $240,000, but at the same time, pay $140,000 in 1 month. So the first thing we did was to net those two, so that we said if you receive 240 and you pay 140, therefore you remain with $100,000. And it is in 1 month, so we use the 1 month forward rate. And remember, we said that the rates have been given to you as a buy and sell rate. So now they have given them to you in this thing of where they give you the rate plus or minus. And to get the buy rate, you subtract. To get the sell rate, you add. Now, since we are going to receive dollars and we want to convert them to pounds, we have to buy pounds. And the bank sells us at 1.7832. So then you just divide 100,000 by 1.7832 for the receipt in 1 month. And then we said that having understood all of that, now for the 3 months, it's as easy as doing the same thing you've done here. So you are dividing 300,000 by the sell rate, which is 1.7846 plus 0.0004. So that's how you get the receipt in 3 months' time. Is that clear now?
Yes, it is. Thank you.
Welcome. So now they also asked us to calculate the starting receipts in 3 months' time using a money market hedge. So for the money market hedge, remember that we said when you are looking at money market hedge, if you are going to receive dollars in 3 months' time, but you want to convert them now, that means that what you do as step 1, you have to borrow some dollars. Then, as step 2, then you convert the dollars to pounds at the spot rate. And finally, for step 3, you deposit the pound for 3 months. So the idea is you want to convert now because you know the spot rate, but you don't want to use the money now. So that's why we have to convert it and then deposit it for 3 months. So now the first step, of course, requires you to know how much you are going to borrow in terms of dollars. So first of all, we need to understand the rate. So the rate, they gave us information here about the money market rates for Nedwen. So remember, we are going to borrow dollars, so we are going to look at the dollar borrowing rate of 5.4. Now, 5.4%, but it's annual. So you multiply it by 3 out of 12 to get the rate for 3 months. So which becomes 1.375 or 1.35. So after knowing the borrowing rate, then you need to know the dollar amount to borrow. So you can just summarize it as dollars borrowed. So remember that we don't want to borrow exactly $300,000. We want to borrow an amount such that in 3 months' time it is equivalent to $300,000. So which means that what we are going to do, we are going to get $300,000. Then we divide it by 1 plus the rate. Therefore, we are going to borrow $296,000. So when 3 months pass, that will become 300,000, and then we receive the money and use it to pay that loan. So that is step 1. Step 2, convert those dollars right now, pounds. Now, we need to know what's going to be the rate. Now, the rate is the spot rate. But again, we need to understand, since we are receiving, we are going to have to buy pounds. So the bank will say to us at the bank sale rate, which is, we already have that bank sale rate. It is 1.7820. Okay, 1.7820 plus, so we are using the spot, plus 0.0002. So that gives us 1.7822. Therefore, the pound value is going to be, now remember, when we are getting pounds, we are going to divide. So it will be the 296,000 that we have got as dollars. Then we convert it at this rate. So we shall get 166,000 pounds. That is step 2. Then the third step will be to invest it for 3 months. So the rate now we are using is the rate for investing, and we are investing pounds. So that will be 4.6% times 3 out of 12, because it's for 3 months again, which gives us 1.15%. Therefore, the dollar amount or the pound amount after 3 months, what is it going to be? So it's going to be the amount that we have converted, then multiply it by 1 plus the rate. So which gives us 167,999. Now, this is the amount that you get after 3 months using the money market hedge. So they told us to compare it with the forward. So we can compare with the forward value. If I use the forward rate agreement or the forward rate agreement, or the money market hedge. So if I use the money market hedge, this is what I get, 167,999. With the forward rate for 3 months, we got 168,067. Therefore, on the face of it, we'll choose the forward rate, the one which gives us a better receipt. So we choose a forward rate. Now, however, of course, forward rate has issues to do with the maybe not being available for all currencies. But since here we are dealing with dollars and pounds, then maybe there's not a problem, because those are very common currencies. So maybe that point may not come up. So choose the forward rate, and you just give a reason, because it gives us a better receipt. So this is how that question was supposed to be done. And then finally, they're asking, discuss how the currency futures could be used to hedge the 3-month dollar receipt. Now, what did we say about futures? So we said that for futures, now remember that in this case, what will be our worry? Since we are dividing and we are going to make a receipt, we are worried that the FX rate is going to Is it going to increase or decrease? What is our worry? Just to check if you're understanding what we are doing. In this current transaction, what is our problem? What do we do? Why don't we want to happen? Anyone? Okay, so now for the futures, of course, the first thing that you need to do is to define them. So a futures contract is a standard contract which stipulates a rate, an FX rate to be used for a fixed contract size. Okay, for fixed contract size, and for basically four dates in a year, being end of March, June, September, and December. That is the first thing that you talk about futures contract. So now, because if you look at this thing we are dividing and it's a receipt, so for us, our problem is that if we divide and we get a smaller figure, and that can only happen if the FX rate has increased. So in this case, for the USD receipt, we are worried about the FX rate increasing. Okay, so therefore, to hedge against it, remember when the FX rate is increasing, that means that the futures price is going to be increasing. So if you think that futures prices don't increase, then you buy now and sell later. We can buy futures contracts now and sell them later. So when you sell them later, therefore the profit made of the futures contracts can be used offset the loss made when the FX rates increase. So this loss is made on conversion. So loss made on conversion when the FX rates increase. So ideally, you are trying to create a balancing figure or a hedging instrument whereby if the FX rates increase, then you are going to make a loss on your transaction, but then you make a gain on the FX future that you have bought, and then you sell it later on. So that's what you can put. Of course, if you go to the solution, you would find that they have mentioned other aspects of it, but the gist of it is that you need to understand what a futures is, and remember that for futures, you can say that futures are exchange traded, and thus could be used for speculation. However, finance managers are bad or do not engage in speculation. So they only go into the transaction to hedge actual cash flows. So here we've got the max, but you could also add something like futures contracts require payment of initial margin, okay? And also could suffer from basis risk. If you remember those ones, but even if you don't remember them, you are able to pass at this point if you have given this much information. So that is the first question. It is not very difficult, if I'm to say so, because the only thing that you should focus on with this question is that you are always going to have to calculate some sort of instrument, either it be FX or interest. And for both of them, you need to know the same math of calculating forward contracts and then also for FX money market hedges. So it's a good idea for you to know these aspects of this question. So if we do not have a question, we have any questions? Have we understood?
No question.
You have a question?
No.
Okay. Okay, so if there's no question, then we can go and do another question. So today we are trying to do all questions that we have that have to do with risk management, as many as we can do, so that we have this information stick in our head. So now we have another question called exporters PLC. So this question, when you look at it, what are the requirements? First of all, they want you to calculate how much exporters PLC gains or loses as a result of hedging the transaction. If at the end of the 6 months, the pound in relation to the northern dollars has gained 4%, lost 2%, remained stable. So, and they're saying that you might assume that the forward rate reflects the interest differential in the two countries. So here they are telling you to use the interest rate parity. They have said it here, also interest rate parity, which we said that is one of the formulas that are given to you in the exam. That is part A for 8 marks. And then compare the forward market currency hedge with the currency futures hedge and the currency options hedge. So here, indicate each of the 3 cases how the hedging facility is actually provided, nature of the costs, and the potential outcome of the hedge. So now remember what I am emphasizing when it comes to FX and hedging. You need to know how futures and options work, because even if you're not going to calculate them, they are definitely going to ask you to explain them, which is what the question is asking for here, for 12 marks. So you can realize that here this question was biased almost more than half on the explanation itself. So if you didn't know how to do the explanations of the options and the futures hedge, then it means that you are going to struggle to get half the marks for this number, which is exactly what I'm trying to bring to your attention. So let's go and see what they are saying. So they're saying that exporters PLC is due to receive 500,000 Northland dollars in 6 months' time. The company decides to hedge its currency exposure by using the forward market. The short-term interest rate in the UK is 12%, and the equivalent rate in Northland is 15%. The spot rate is 2.5 Northland dollars to the pound. So we can first of all just take this in the Excel. So we are looking at exporters PLC. So remember that what we have at our disposal they have told us that we are receiving 500,000 Northland dollars. So receipt in 5 months, no, 6 months, 6 months, and this is Northland dollars, 500,000. That's the receipt in 6 months. Okay. Now, if you look at it, you see that they have given us the short-term interest rate in the UK and the one of Northland, but the spot rate is 2.5 Northland dollars to the pound, which means that the base currency is the pound, and then the counter currency is the Northland dollar. That is very important for us to know, because once we know it, then we can now put the interest rate for the counter currency, interest rate for the base currency. So because the base currency is the pound, therefore the interest rate for the base currency is 12%. And therefore the one of the counter currency is 15%. Then we can have spot, Northland dollars, the pound. And right now it is at 2.5. Okay. So which means that now we can, first of all, remember, we need to first of all determine how much the exporters PLC actually gains or loses. That is assuming that there has been a gain in the pound in relation to the dollar, or there has been a loss of 2%, or nothing happened. Now, so given that we are going to work with 6 months, you can easily convert these ones into 6 months rates by multiplying by 6 out of 12. Even this one. Okay, it's important that we because remember the formula that we are using. If I open the formula sheet, we are going to use the interest rate parity. So if I'm to bring it out, this is the interest rate parity formula. And what we are going to do is to use it to predict the forward rate in 6 months' time. So, and the forward rate, so we are going to call it the 6 months forward. So it's going to be the spot, which is 2.5, multiplied by 1 plus interest in the counter currency, divided by 1 plus interest in the base currency. So now you realize that if you hadn't put these figures right, then ultimately you're going to get a wrong forward rate. So you need to identify the base currency and the counter currency properly. So this one gives us 2.535 as our 6 months forward rate. And now we can now look at the 3 scenarios. So the first scenario, they said we have a gain of 4%. So if there was a gain of 4%, that means that, remember that this is a gain of 4% in 6 months. So that means that what will be the rate? So the rate.
Excuse.
Yes.
Excuse me.
Yes, Godfrey.
Could it be because of rounding off? Because I had gotten 2.547.
No, not rounding off. Did you convert this one to 6 of 12, 12, and then also this one, the IC and IB? And do you have them
Yes.
IC and IB? Because remember, we have 12 and 15. You need to identify them that the one of 15 is IC, and the one of 12 is the one which is IB. Do you have those figures 8 and 6 here?
Yes.
Then,
But
then when you are doing you multiply the spot, which is 2.5, by bracket 1 plus the counter currency, which is the 8%, divide by 1 plus the base currency, which is the 6%. Is that what you have done?
But I think my calculator, maybe it's the one that has issues. I don't know.
Because anyway, you check, because if you have done exactly that, then there's not going to be, yeah?
Custody procedures will remain the same.
Yes, you check, but rounding error is the one that caused that big change. So now, if we are looking at gaining 4% in 6 months, that means that instead of having 2.5, you have it as 1 plus 4%. That's what they mean.
You are breaking.
I'm breaking. Am I still breaking?
Is it my network? Because
no, I also can't hear him well. You're breaking, Herbert.
Can you hear me now?
Maybe someone is calling on his network. Hello?
Yes, you are.
Breaking?
Now you can hear me? Hello, Godfrey, can you hear me now?
We are still not listening. I mean, hearing.
Hey. Can you hear me now?
Yes.
Yes,
okay.
Perfect.
Okay. So we are saying that if the spot was 2.5 6 months ago, now in 6 months' time it will have become now 2.6 if it grows by 4%. Okay, so that's the first scenario that they asked us to consider. So now remember that now what would happen if I made a receipt? So if I convert without spot, I mean without the forward rate, what will I get? Remember that we are receiving 500,000 Northland dollars. So to convert to pounds, we are going to divide, right? So if I converted without the forward contract, I will get 500,000 and I divide it by 2.6. So I'll get 192,308. Then if I convert using the forward rate, then I'll have $100,000 divided by the 6-month forward rate that we have got of 2.535. So which means I'll get 197,209. So by me using the forward rate, I am getting less. Did you see? No, I'm getting actually more. Therefore, here I'm making a gain of 197 minus 192. So I'm getting a gain of 4,900. Is that point clear? From that gain?
Yes.
Okay. So now we look at the second scenario. What about we lost 2%? So if the currency loses 2%, That means what I could do is actually just copy everything here. And then so the spot will be the 2.5 multiplied by now 1 minus 2%. So it will become 2.45 instead. So if I convert without the forward contract, I am dividing 500,000 by now 2.45. Then if I convert using the forward contract, I am dividing 500,000 by 2.535. So I am actually making a loss in this case, because when I use the forward rate, I get 197, whereas if I don't use the forward rate, I get 204. So it means that in this case, I'm better off not using the forward rate. However, the forward rate is contractual. You have to use it, which means that I'm going to lose 6,000 pounds. So that is it if it lost by 2%. And then the third one, if it remains stable. Of course, if it remains stable, that means that I am going to just copy this. And then if it remains stable, that means that I'm looking at, again, 2.5. So it did not change. So if I'm converting without the forward rate, I will have 500,000 divided by 2.5. And then if I'm converting using the forward rate, of course, we are using 500,000 divided by the forward rate that we have predicted of 2.35. Again, I'll make a loss of 2,700. So I hope that is clear on how that works. Now, second part. So this second part, what we are going to do, I'm going to take you through, but then I'll take you through the solution also, so that you see exactly how you write this. Because remember, it is very important to know how to answer what a forward contract, what a futures hedge and an options hedge are. So, but let us first look at how you understand a futures hedge. So we are looking at part B. We are looking at the futures hedge. So just like what we have just done before in the question, remember that this is a receipt. So because it is a receipt and we are receiving the Northland dollars, so when we divide them by the rate, we are worried that that rate has increased. So our worry is that the rate has increased, which means that to avoid that issue, since the futures price will also have increased, we can buy futures now and sell them later. So this is basically the summary of it. But now, of course, I'm just putting this here, but then you need to realize that we are going to explain what a future is. So remember, the question was clear that we are comparing the forward market with the futures hedge. So we are not just talking about the future. So you can say that a futures hedge is similar to a forward contract, in that provides a fixed rate to be used at a future date. Okay, that's how they are similar. However, how are they different? However, a futures hedge is not over the counter, and thus exists in fixed contracts, fixed contract sizes, and has four dates of exercising. Okay, remember that we talked about this in the previous question. So it has the March, has the June, has the September, and the December end dates. Now, so now we can say to hedge against the futures, I mean against the FX increase, or you can say to hedge the FX receipt of 500,000. These are dollars which are called Northland dollars. Then you can say you need to put in the company. So exporters PLC, and buy futures contracts now and sell them later, so that in case of an increase in FX rate, the loss on conversion can be offset by the gain on the futures instrument. Okay, so that is something that you can mention about the futures. So now you see the also other thing, because of the fact that first of all you need to make sure that the Northland dollars also exist in that future, right? So however, there is a possibility that the futures contract does not exist for the Northland dollars and pound, and thus it could not be obtained from the market. Okay, that's why the over-the-counter ones are better, because you go there and you ask for what you want. Then you say also you can say also there might not be a perfect hedge due to the fixed size contracts. Okay, so that's how you deal with the futures hedge, comparing it with the forward rate. So then you can now look at the options. So the options hedge. So you say the options hedge gives you can use the company, you can say gives exporters PLC the right but not the obligation to exchange an amount at a fixed rate at a future date. Then you say, like the futures, they are traded on the market and exist for 4 dates, okay, which is the March, June, September, and December month end. Then you say so we have already said that they are on for 4 dates, also they are for fixed contract sizes. but they don't have okay, you say so there may not be a perfect hedge. Okay, because as we said, when there are fixed size contracts, that means that you go out there and you determine how many contracts you need. So you may under hedge or over hedge. So now the options. So what you need to understand is that if you bought here, like here, we say that for us to hedge, we would have to buy futures now and sell them later. So that means that in this case, we shall need to buy call options. So exporters PLC need to buy call options and only exercise them if the FX rate increases, okay, beyond the exercise price of the option, but doesn't have exercise if the FX rate falls. Then you also mentioned that options require payment of premium benefit from the right and not the obligation. So now, of course, you see I'm just using one line for each. For you, if you are spacing them very well, each of these ones is going to be a point of its own. Remember, there are 12 points and 12 marks, and you are not supposed to raise 12 points, but you kind of even it out between the futures and the options. So, of course, you have to compare. Remember, I told us to compare the forward rate with these things. So here you have not yet compared the forward rate with the options. You can compare it by saying that the forward rate is a contract for it. When you enter into it, you have no way of backing out. Yet the options, you have the option to exercise or not to exercise. So I do not know if you have questions regarding that or everything is clear. Any questions?
More explanation on those periods. I don't know whether I missed it yesterday, but one
Yeah, I told
where they are
you.
saying March, June,
Yes,
September, and December
yes.
in
Remember that
respect to option then futures.
yes. Remember that for forward contracts, you go to the bank and you tell them that I need to exchange my money in 5 months. Give me a rate to use. So that is forward rates because they are over the counter. But for options and futures, they are on the market. So they exist in the market and they give standard contract sizes, like for example, 2 million. But they also they normally call them the June futures, March futures, September futures, and December futures. They are usually for 3 months. So if your receipt is going to be in the, like for example, in August, then of course you can't use the June ones because August is after June. So you need to use the September ones. So of course, when you are doing AFM, there are other aspects that come into there, calculating the rate that you are going to use. But for us, we have to just understand they exist only in these 4 contract sizes. We have March, and they also exist. They exist in. You have 4. They usually having 4 dates. So March, June, September, December. So you always choose the one that you buy on the market based on your transaction date, the anticipation that you are going to transact. So that's the 4-month thing, or the 4-date thing in this case. Any more
Okay.
questions?
Not from me.
Okay, so let us take a short break of 5 minutes. Then we do another question.
Okay.
Right.
Yes.
So I was supposed to go through the solution so that you see how they are phrasing it, but I'm going to just leave that for you to do. So let us do another question. So this question is called CC. So CC is considering launching a new product, but let's first go and see what they are asking us to do. So calculate expected dollar payment in 3 months' time using both a forward market hedge and the money market hedge. So these are the two that I said you always need to calculate and recommend whether forward market hedge or money market hedge should be used for 6 marks. Then based on what you recommend, calculate NPV of the proposed investment in 3 months' time and comment on the project's acceptability. Then discuss inflation on exchange rate. Okay. So when you look through what they are saying here is that we are considering launching a new product. So this is the information: selling price, variable costs, incremental fixed overheads, given to us in dollars. Then we have general price inflation is 4.7% per year over the period. However, the selling price is going to inflate at 5% per annum, variable costs at 4%, and the fixed costs at 6% per year. Now, when you looked at the inflation, we said that there is specific inflation and general inflation. And here they have given us both of them in the question. So just need to know when to use what. This is what we have given us for the production and sales level for the following 4 years. But to manufacture the machine, the product, we shall buy a new machine, and the supplier of the machine are overseas. If we order it immediately right now, we would pay 1.5 million euros. And the payment would be made in euros and will be done upon delivery of the machine in 3 months' time. So now remember, right now it costs 1.5 million euros, but we shall pay in 3 months' time. That's the one they're asking us here in this part A. So we shall be able to claim tax deduction on investment on a straight line basis over the estimated 4-year life of the asset. We pay tax on 1 year in arrears at 30%, and the asset is not expected to have any scrap value at the end of the project. Then we have the real weighted average cost of capital of 5.1. You really need to understand the term real and nominal. So these are things that we talked about when we looked at inflation. So this question here combines both FX but also NPV and inflation. So it's going to help us to break ground with the NPV calculations, which are very essential for your paper because you are always going to find yourself having to deal with some NPV of sorts. So they gave us the spot, and they are saying euros per dollar, so the dollar is the base currency. And the 3 months forward exchange rate is 0.698. So they gave us the forward rate. We can earn 2.9% per year on short-term euro deposits and can borrow at 5.5. Now, this question, when they give it to you like this, without giving you the borrowing and deposit for both of them, they kind of give you a clue of what to do. But for us, we should attempt it like we don't know. So let's first go and look at the dollar payment in 3 months' time using the forward market hedge and the money market hedge. So this question here is called CC core. So let us first look at part A, but let us consider the forward rate. The forward rate is always very easy. So the spot is 0.7, and the way they have given us the spot, they haven't given us two things whereby we have to choose whether we are buying or selling. So they have removed that ambiguity. So we don't need the spot for the forward rate because we already have the forward rate. So let us bring the forward rate. The forward rate is 0.6. So this is the forward rate, 0.698. So, and this is a 3-month forward rate. Therefore, the dollar payment is going to be, now remember that we are converting to dollars, which is the base currency, so we are dividing. So it is 1.5 million. So 1.5 million divided by 0.698, which gives us $2.14 million. That is if we are using the forward rate. So then let's look at the money market hedge. So this is the forward rate payment, money market hedge. Now for the money market hedge, since this is a payment and we are paying it in 3 months' time, so that means that I need to have the euros in 3 months' time. But I want to convert now. So what I'm going to first do, I'm going to borrow some dollars. Now, that's going to be the step 1. Then step 2, I'm going to convert the USD to the euro at the spot rate as step 2. Then step 3, I need to deposit the euro for 3 months. Now, of course, even though I'm writing it like this, I already showed you that the steps I'm going to follow, because I need first of all know how much I need to borrow in dollars, and I cannot know that without knowing how much euros that I'm going to need to convert. So remember that we are going to pay 1.5 million euros in future. So what is the rate for depositing? They told us that we can earn 2.9%. But this is for a whole year, and this is going to happen for 3 months out of 12. So which becomes 0.725%. So that is going to be our rate. Now, I need such that when I deposit my euros, they become 1.5 million euros in 3 months' time. So how much euro that I deposit? Going to be 1.5 million divided by 1 plus this rate here. So I need to actually deposit 1.489 million. So because I need to deposit 1.489 million, then that's what I'm going to convert. So step 2 was to convert dollars to euros at spot rate. So now I know that the dollars that I'm going to deal with is 1.489. But what's the rate here? The spot rate they've given us as 0.7. Therefore, the dollar amount is going to be, remember the dollar is the base currency, so I'm going to divide the euros by 0.7. So that becomes 2.127. So those are the dollars that I'm going to get, and therefore Since I don't have those dollars, I'm going to borrow. So the rate for borrowing dollars, they told us that it is 5.5%, but it's for 3 months. So we do 3 out of 12. It becomes 1.38% or 375%. So after getting that rate, then I can know the US dollar payable in 3 months. So basically it will be 2.127 multiplied by 1 plus 1.375. So which becomes 2.156. So this is the US dollar payable in 3 months' time. And now I can compare the two. So for me, I prefer to compare by putting here a forward contract, then money market hedge. So the forward contract we got that the payment will be 2.148, whereas the money market hedge has given us 2.156. Now remember, these are payments. Therefore, for the payments, we should choose the one which gives us the least. Therefore, the forward contract seems to be a better option here. So we can say the forward contract should be used instead of the money market hedge. Okay, so I hope that you have understood how we have completed the money market hedge, because the forward contract is very easy. So now they told us that now, based on what we have got, now let's calculate net present value. So now what comes next is pretty much what we have been doing for some time now. We set up, so years 1, 2, 3, 4. So remember, this project is for 4 years, but we pay tax 1 year in arrears. So we are going to need 5 years. So now we have, we are going to deal with, since we are using Excel and all that, we may just use dollars, but we can save time by saying, let's use thousands of dollars. Okay. So now, of course, we have selling price, variable cost, incremental cost, and units. So we can make a working here for revenue. So that working for revenue, now remember what we are going to need to put here. We are going to put revenue, variable cost. Then we are going to put fixed costs. And then from there, we shall put taxable depreciation. So now we need to do revenues, which is working 1. So for revenue, we are going to bring the units. So the units, so we have here year 1, 2, 3, 4. And the units, they told us that 250,000, then 500,000, then 400,000, and then 200,000. So those are the units. Now, so we have selling price. Now, they have told us that selling price is in current price terms. So we are going to have to inflate it. And the inflation for the selling price is going to be 5% per annum, which means that I'm going to have 12 as the selling price, multiplied by 1 plus 5%, power 1. So that is the one for the first year, then the others. So I can just make them 2 decimal places. That's the selling price. Now I can put here revenue, but I want it to be in thousands of dollars. So remember that if I multiply just this by that, I'll get dollars. So I can divide by 1,000 to make thousands of dollars. So, or you could just work with dollars. That's what I said. So you have your revenue. So you can come and bring it here. Those are our revenues. Then variable costs, they gave us 7 per unit. So let us use working 2 for that. Now, we have here working 2 variable costs. So you can have variable costs per unit. They gave us 7 per unit, but inflating at 4%. Therefore, 7 multiplied by 1 plus 4% power 1. So when you drag, so that is, those are the variable costs per unit in inflated amounts. Then now we can have variable costs in thousands of dollars, which means that we are multiplying the units by the variable cost per unit. But we divide by 1,000 because we want it to be in thousands. So that gives us 1,820 and those amounts. So you can come here and bring the costs. Okay, those are variable costs. Now fixed costs, they are saying that they are going to be 250,000 per year, but at 6% inflation. So those ones we can do it directly from here. So that is 250,000. So remember we're working in thousands, so that we are going to be 250 multiplied by 1 plus 6% power 1. So those are our fixed costs. Okay, so now that we have our fixed costs, we need to do depreciation. So depreciation, we can have here a working 3, tax allowable depreciation. Also can be called TAD for capital allowances. Now, so we have here year 1. Now the cost, now this is where you have to bring the cost that we have done from. Now remember that they have told us that tax allowable depreciation. Oh, okay, you can even, you may not need the working for this because it is in a straight line basis. So if it's straight line basis, you may just divide. Okay, so we don't need this working because this working, which I was going to put here, mostly works if you are doing reducing balance. But if it's straight line, all you do is just come here and divide. Remember the figure that we chose to use is 2.148 million. So you just divide this one by 1,000 because we are working in thousands. And the project has 4 years, so divide by 4. So you just get your answer there as 537.25. And then we want it to be minus. I'm going to fix this one so that I can drag the formula. So that's the depreciation. So from here now, I can get my taxable cash flows. these are my taxable cash flows. Then I now tax them. And they told us tax is 30%. But it's 1 year in arrears, which means that the one of year 1 will be in year 2. So you can just do 30% and then you offset. So that's how you get that tax offset 1 year in arrears. Now, the first thing that you do when you get the tax is to add back the third, because depreciation is not a cash flow. So you add it back right away. So after you add it back, then we look at the cost. Now the cost is the same that we are going to use, the 2.184. So just bring it here, but we're working in thousand, so divide it by 1,000. That is our cost. And there is no scrap. So you can put there 0 just to remember that there's no scrap. So is there anyone who could not reach this point? Because from here, we just get our total cash flows. So our total cash flows are those. And now I'm going to show you 2 ways of dealing with this, because I already showed you before. At this point, you can get discount factor. Now remember, one thing that you need to realize is that we have inflated everything. So therefore, these are nominal cash flows. Okay? That is one thing you have to realize, that these things are being inflated. So they are nominal cash flows. And because they are nominal cash flows, we have to now go on and now inflate, right? Because remember, we have been given the real weighted cost of capital. So this is the real cash flow. So we have real. So we can actually have here a working 3 nominal cost of capital. So the real rate, they have given us 5.1%. Now, general inflation, they told us it was 4.7%. Now we can get the nominal rate. Now, in the formula sheet, we have this Fisher formula. Let me just bring it. We have this Fisher formula, and it says 1 plus I, and remember that I is the nominal rate, is equal to 1 plus R. R is the real rate, multiplied by 1 plus H, which is the general inflation. Okay, so this is what we have. Therefore, I can get I by saying 1 plus R multiplied by 1 plus H minus 1. So which gives me 10%. Okay, so the rate is 10%. You can assume that it's not even 10.04, you say 10%, because if you want to go to the tables, then at this point you say discount factor at 10%. Then you can go to the tables, which if you go to the discount counter table and then you put 10%, you get this figure 0.909 up to 5 years. So these 5 figures. However, as you know by now, we are going to use the formula. So 1 plus the rate, and you can fix the rate here, power minus n. So that saves us from having to go and copy those figures and possibly copy them wrong. So those are discount factors. Then we can get present value by multiplying the cash flow by the discount factor. Then now we can get NPV, which is basically the sum of the present values. Now this is the formula. This is how you do it if you wanted to go that route of using the discount factor, the present value, then NPV. However, in the exam, you have NPV using the formula, okay, which is what I recommend using. So you just say NPV, give it the rate, and then give it the cash flows from year 1. So from year 1 all the way to year 5, close bracket, and then subtract the initial investment. And because it's negative, so we add. So you get the same exact answer. But you have saved yourself from having to do discount factor and present value and NPV. You get it in less than a minute. So this is what the examiner likes that you use, but they don't force it on you. If you don't know how to use it and you don't want to use it, you can be without it, but it saves you time, as you have seen. So because NPV is positive, we accept the project. All right. So any questions, or are we okay? Are we understanding? Are you following? Yeah.
If this one they bring it in a paper, the trick was not easy.
Where is the trick, Godfrey?
To read it from forward, what, then they would have brought a direct question by not, because now when you don't know how to determine the figures,
Okay.
in case of an exchange rate, then you are out.
No, you are not out. You see, I hear you what you're saying about the fact that they are mixing questions, but you have to realize that ACCA can mix questions, and especially when you go to advanced level, they mix different topics together, because the only thing that has changed from the NPV we have been doing before is that we have to first do the forward rate and money market hedge to pick a figure to use in our NPV calculations. Now, I told you that FX or interest rate is going to come in some way or shape in your exam. That is a given. There is no way you are going to escape it. Now, if they chose to bring it as part of another question, that's also something that they can do, or they can bring it as its own question. Now, if they bring it like this as part of a question, you, of course, I expect that you are going to be knowing how to do it and pass. But in case you didn't know and you got a wrong figure here, and you continue and use it here, but by referencing it up, like, you see how we are saying that we are bringing the cost? You see that I'm referencing it from up. I'm just not writing there a figure. So that means that they can understand where your wrong figure is coming from. You won't be penalized again in the NPV computation. That's what they call the own figure rule. As long as we are not writing their figures by just typing them and they are referencing them, they can't penalize you twice. You fail it here, whatever you get, you can use it here when you are looking at the depreciation. No problem. They will give you marks for it, even for putting it here at cost, which means that for you, your task is to get everything else right And these ones won't make you wrong in any way or form. So do not say, what if you don't know how to get that figure, you are off. No. And the thing that most people do wrong is, now if you have that mentality like Godfrey is saying, and you fail that first part, you even leave the question and go to another question and not even finish it. And there, if you do it in the exam, you have failed. Come out knowing you have failed. Because whatever you don't do, you can't pass. Okay, I want this to be very clear. This is now exam technique. Okay, in case you don't know how to calculate this thing at all, you can write here a line saying, assuming that the dollar payment is 2.4 million, then you come and use it here. Okay, so that you have marks for the rest of the question. Is that very clear, Godfrey?
Yes, that was my worry. But now you have explained it.
Yes.
That in any way, if I get a wrong answer on the forward, still I can go ahead and use the very answer and keep on referencing it and get some marks down there.
And you get all the marks for the second part, not even some marks, all the marks.
Oh,
they won't penalize you at all for the second part for something you get. So you get all of the 10 marks from there.
Okay.
If you get everything else right. Okay?
Okay.
Yeah. Now, the third part is the one that they ask us to discuss the impact of inflation on exchange rates. So, of course, we have this formula here, the purchasing power parity. That's what they're asking for. But they're asking you to explain it in words. So now, of course, you are going to say that the purchasing power parity looks at the relationship between the inflation between the two currencies based on the inflation that you have in the different countries. So remember that you have the counter currency and you have the base currency. And here, what this means is that if the inflation in the base currency is higher, okay, then what is going to happen to your predicted spot? It will be lower. So if the inflation in the base currency is higher, then we say that the base currency has lost value, and therefore the predicted spot will be lower. However, if the inflation in the host currency is higher, then it means that the base currency, or I'm talking about counter currency now. If the inflation in the counter currency is higher, then it means that the counter currency has lost value against the base currency, and therefore the spot rate will be higher. So that's the relationship that they have between them. So, of course, maybe what I can do is to take you to the solution of that so that you see what more they have talked about, the inflation and exchange rates. So let us look for CCCO. Okay, let me just use exporters. Okay. So CCCO. So of course, here we have done the same thing. We have reached to the same conclusion. Cash flows are laid down here, no problem. NPV is acceptable. Workings are provided here. In case you don't understand some part that we have done, you are all welcome to go and check the solution for that. But what I've brought us here to do is to look at the discussion on inflation and the exchange rates. Now, Purchasing power parity theory claims that the rate of exchange between two currencies depends on the relative inflation rates within the respective countries. So this is the formula of purchasing power parity. Now remember what I said about when you got the solutions that are in this book. You should focus on what is highlighted. Do not write so much. Remember, it's for 4 marks. So here on this paragraph, this is all we are writing, but the other parts are for you to understand. Basically, it is based on the law of one price, which says that identical goods should have the same price regardless of the currency in which they are sold. You don't have to say this in the exam, and you can see it has not been highlighted. So now, and then they're saying also that we can determine exchange rates in some way if we know the relationship between the prices because of the law of one price. That means we're looking about the inflation rate. So then they go on and put here the formula for purchasing power parity. And then they discuss what we have just said when I explained to you that a high level of inflation in an economy relative to the inflation of the overseas result in a depreciation of the currency. As a result, the currency fluctuation imports will cost more, but more easier to export since goods will appear cheaper to overseas purchasers. So here they are explaining inflation basically. But what you have to understand from here is that if inflation in the host currency is higher or the base currency is higher, that means that the base currency has lost value, and therefore you're going to have a lower FX rate. Is that very understood? Hello?
Yes, but now
Okay.
where you find that because when I see the formula for PP, it's not highlighted. And then I was like, in case I give some explanation, then I give the formula, then I explain it. Would they give me some marks? Because I can see they don't earn any mark from here. Yet the other terms may not be easy for so someone to explain.
Please understand when I talk about the highlighting, this highlighting was not made by the examiners. This highlighting was made by the Kaplan people looking at points that they deem to be of importance. But I can tell you for sure that the formula is important. However, this formula is given to you in the exam. Therefore, they don't give you marks for repeating something that is already given to you. Like if you know about open book exams, they won't give you marks for just saying something that you haven't added any context to, be it from the scenario. Like if you start answering questions of case studies, you can't just copy something and paste it in Word and expect to be given a mark. So you have to explain this, and the explanation that you are giving is this part here. You understand? So it is okay for you to have it here, but they won't give you marks for just, let's say somebody just came and put this thing here without adding any more context. They wouldn't even get 1 mark. That's what this means. Okay? Now, depending on how fast you are at typing, you could put more information like this, which has been provided, but on its own, it is not going to be scoring you anything. What is most important is what is highlighted. As for the examiners, did you get that, Godfrey?
Yes.
Yes, it's okay to put the formula there and explain it. You'll be given marks, but you realize that the explanation that you are giving will be what has been highlighted in here. But of course, they always give you marks for some other alternative explanation that is not envisaged by the examiner, because the person marking you will read your results and see if you are making sense. So the reason why I said about the highlighting is that when you go to the solution that Kaplan gives, they can be so huge. and you may think that you have to present so much content to get the marks, but no. Okay, that's why they highlight some parts that they say would be most important for you to get marks in that exam. Okay, they put it here that the highlighted words in the written sections are key phrases that the markers are looking for. Understand that aspect?
Yes.
Okay. So do we have any more questions? No? Okay. So if you don't have
No.
any questions, yeah? Somebody will say something? Beatrice?
No, I said no question for
Okay.
now.
Okay. Okay, that's okay. So now I think we are left with just a few questions, if not just one or two from this section. So we shall resume on Tuesday and finish it so that we can now go and look at other topics. So wish you a good night and have a good weekend.
Okay. Thank you. Lovely weekend.
Good weekend too.
Bye.